You signed a blank check. Nobody told you that's what it was. Somewhere in your closing paperwork, on a page you skimmed past to get to the signature line, you agreed to let your lender automatically pass through tax and insurance hikes straight onto your monthly bill. Not your rate, not your loan balance, your actual bill. No vote, no negotiation, no warning. Just a letter months later telling you the number changed. You were sold a fixed-rate mortgage. 30 years, same rate, same payment, predictable, safe. That's the pitch. It's also not the whole truth. Your rate can sit locked at 6.49% for 3 decades, and your monthly bill can still climb $300, $400, or more, because the part of your payment that isn't the loan itself was never fixed at all. Here's the promise. By the end of this, you'll know exactly what that clause is, why it's hitting harder in 2026 than it has in years, and the real math behind how it adds hundreds of dollars to your payment without your interest rate moving even 1 basis point. It's called your escrow account, and it's sitting in nearly every mortgage with less than 20% down. Yours too, probably. Here's how it works, stripped down. Your lender doesn't just collect principal and interest. They collect a slice for property taxes and homeowners insurance, hold it, and pay those bills for you. Convenient in theory, a loaded weapon in practice. Because the numbers underneath it are climbing faster than your paycheck ever will. Insurance first. The average homeowner's premium is projected to hit $3,057 by the end of this year, up 4% from last year, up 46% since 2021. Insurance now eats about 9% of the typical monthly mortgage payment, the highest share ever recorded. Ever. That 46% didn't happen because your roof got worse. Researchers tracing tens of millions of mortgage escrow payments found the real driver, reinsurance, the insurance that insurance companies buy to cover their own catastrophic losses, roughly doubled in price between 2018 and 2023. That cost didn't stay with the insurance company, it got shoved straight onto your premium, and nobody asked if you were fine with that. Some states are getting hit worse than others. California is facing a 16% jump this year, the steepest in the country off the back of wildfire losses. Nebraska, New Mexico, Georgia, all staring down double-digit hikes too. Now property taxes. The average homeowner paid $3,018 in 2024, up 27.4% since 2019. Home prices climbed 51.6% over that same stretch. When your county reassesses your home at a higher value, and right now that's happening constantly, your tax bill rises with it. It doesn't ease in gently, it lands in one notice all at once. Here's the mechanism that turns all of this into your problem. Once a year, your servicer runs an escrow analysis. They check what they collected against what they actually paid out. Come up short, and by law, they can spread that repayment across the next 12 months. They're also allowed to hold a cushion, capped at 2 months of payments, as their own buffer against the next surprise. Your buffer, their rules. The average shortfall going into this year? $2,157. Spread over 12 months, that's about $180 added to your payment. Permanent, on autopilot. No vote, no negotiation, no warning until the letter shows up. And that's just the average, not the ceiling. Here's how a real homeowner blows past $400 a month using nothing but verified numbers. Say your payment last year was $2,200. Your county reassesses your home this spring. Tax bill rises $1,080 for the year. That's $90 a month. Your insurer, staring down higher reinsurance costs and a rough storm season in your region, raises your premium $1,200 for the year, another $100 a month. And because last year's escrow never saw either increase coming, you're also short about $2,150 from that year, split across the next 12 months, another $180. 90, 100, 180. Added up,
$370 more every single month, and your rate never moved once. A recent industry survey of mortgage servicers found property taxes are now the single most cited driver of these jumps, named by nearly 2/3 of respondents, up from just over half a year before. Insurance was cited by close to half. This isn't bad luck hitting a few unlucky homeowners. This is becoming the standard experience of owning a home in this country. Here's how bad it's gotten for some people. A Consumer Federation of America analysis found premiums rose in 95% of zip codes between 2021 and 2024, adding $648 to the average policy. And a separate Lending Tree survey found 1 in 5 homeowners said they'd cancel their insurance entirely. Entirely, if their lender didn't legally force them to carry it. That's not someone shopping around for a better deal. That's someone who's done. And the only thing standing between them and dropping coverage is the same clause we're talking about right now.
Escrow itself isn't the scam. Paying $3,000 in taxes in one lump sum would break most households harder than paying it in 12 pieces. What's broken is the size of the numbers now running through a system nobody rebuilt to handle them. So what do you actually do? Read the annual escrow analysis when it lands. Don't set it aside. It has to break down exactly what moved, taxes, insurance, or a shortage, and that tells you which lever is actually yours to pull. If your tax bill jumped from a reassessment, appeal it. Your county assessor's office, not your lender. Deadlines is short, often 30 to 90 days from the notice, so move fast or lose the window. No guarantee, but plenty of homeowners have gotten their assessed value knocked down just by showing comparable nearby sales. Shop your insurance before you accept the increase as fixed. Premiums for identical coverage swing hard between insurers in the same zip code right now, especially with some companies retreating from high-risk areas while others are still competing there. And if you're given the option, pay a shortage as a lump sum instead of spreading it out, costs more upfront, stops you from carrying that drag on top of an already heavier bill for a full year. You didn't get a worse loan. Your rate never touched. But you signed onto a system that's now outrunning most people's paychecks. And the only real defense is seeing it coming before it shows up as a number you don't recognize. If this made sense of a bill you didn't understand, subscribe. Next up is the pre-approval letter that isn't actually the promise most buyers think it is. And if your payment jumped this year, put the number in the comments. I'll tell you straight whether it lines up with what's happening nationally or whether something's off and worth fighting.